From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, bonds sell off big time, pushing the U.S. long bond yield to its highest since 2007. The resurgence in oil fueling inflation concerns less than a week before the next Federal Reserve interest rate decision. Traders are now pricing in 2 rate increases by January. And in Europe, the region's central bank leaves the door open to a hike in September after standing pat today. We begin with the big issue, a pickup in inflation risks.
The U.S. economy continues to chug along.
I just don't think that we're at the point where we're seeing widespread inflation.
When we look at the drivers of inflation, they all suggest upside risks to inflation pressures.
It's all fun and games until the Fed has to pump the brakes.
So far, the data has not sent a clear signal that the Fed should hike immediately.
I still think, it will come down to the data.
I'm hard-pressed to see Fed tightening.
Right now, the bar does seem higher for cuts.
Perhaps the best thing to do is not do anything.
I think the Fed is going to be on hold through the rest of the year.
Every meeting is a live meeting, depending on what needs to be done.
And of course, the spike in Treasury yields this week gets my attention, but it's not like this suddenly happened. The 30-year yield has now traded above 5% for 13 straight days and 28 days this year alone. That's about 19% of all sessions year to date. You can see that that's the most number of days and longest stretch since 2007 when it traded above 5% for 50 days. But unlike 2007, the Fed's benchmark rate is currently 150 basis points lower, so a sign that investors are demanding even more compensation for holding the longest maturity than at the start of the subprime debt crisis. Meantime, on the other side of the world, the European Central Bank has decided to keep interest rates steady, with President Christine Lagarde signaling the bank may hike in September.
There were some governors who asked themselves whether we should not consider a hike. In other words, raising the 3 interest rates on the occasion of that meeting. And we had really a good, thorough look at the data, at the current development, and we all unanimously decided that we were positioned adequately to wait and be very attentive in the next few weeks to the development of the situation and to the data that we will be receiving in the next few weeks.
Bloomberg's international economics and policy correspondent Michael McKee joins us now with more, and he's got a chart in hand, of course. I go back to what Christine Lagarde said, which is attentive to almost everything out there right now. And of course, you're keeping your eye on where oil prices are and how traders are pricing in the prospect of rate hikes.
Yeah, she's got to be attentive, as all central bankers do at this point, to Donald Trump and what he's doing in the Middle East and whether or not he's ramping up even more the return to fighting with Iran. Interesting comment in the minutes of the last Fed meeting in June, where they said almost all of the members indicated some policy firming would likely be warranted if inflation would remain elevated due to strong AI-related demand, the conflict in the Middle East, or the effects of tariffs. Well, what do we got? We've got strong demand. Look at the Google AI spend announced last night. Middle East, $100 Brent today, and tariffs, 50% on Canada this week, and then tomorrow we're probably going to get a whole bunch of more tariffs to replace the ones that are expiring. So you want to check off some boxes for why you might think the Fed is going to surprise people and raise rates. There are reasons to think they might not, but you take a look at the chart I brought along here, and the markets tend to tell you what is going to happen, which is what Kevin Warsh wants them to do. Take a look at the white line, that's the Fed funds rate, and you look at the blue line, that's the 2-year note yield, and you can see that it tends to foreshadow what the Fed is going to do. And take a look over on the right. It's kind of hard to see because I got an extra line in there. What's happened is the 2-year note yield has shot up over the last week or so, well above where the Fed is, suggesting that the market is pricing in at least a cut. And then the yellow line is Fed funds futures, and they have in the last 24 to 48 hours really started to push in a much greater chance. We're up to about 36 to 40% chance of a surprise rate increase next week. Now, ordinarily, you would say they're not going to do that because they haven't warned us. But now we've got the Warsh administration, which says we're not going to warn you. They did announce that they're going to have the regular press conference, but maybe that's because he's got something to say, as he says.
There's a lot of people wondering about all that. Michael McKee, stick with us because we're going to dig into all of this with Torsten Slok. He's our chief economist at Apollo for our macro conversation. Of course, Mike, a part of this conversation too. Torsten, is this all kind of predicated on where oil goes? Because Mike highlighted the last 24, 48 hours, and you see Brent touching $100 a barrel today.
Well, I think there are also other things going on because inflation has just been remarkably sticky at around 3.5%. The Fed's target is 2%, so the starting point for where inflation is also very, very critical in this debate. Unfortunately, the shock that we're now experiencing with higher oil prices is pushing us in the wrong direction. And that's, to Mike's point, likely the reason why the market is now pricing that really out of the blue in the last week or so. Now suddenly we're having a conversation after a week ago that was only priced in a very, very low, less than 10% chance that they will hike next week. And now we are close to almost 50%, 40-50% chance that they will hike next week.
Do you see us getting past 50% by next week?
Well, the challenge is, as Mike also mentioned, is that we really don't have any forward guidance to hang our hats on. And when we don't have any forward guidance to hang our hats on, the challenge is that we then need to, of course, begin to make our own views. And those views, of course, are centered around what are other FOMC members saying. And we have a very important situation at the moment because several other FOMC members have certainly been signaling, especially Beth Hammack. We also had Chris Waller. We have had a number of FOMC members saying, well, maybe we should be hiking rates. So that's why the now, of course, press conference also coming along. Yeah. There's just a lot of uncertainty about exactly what will happen next week.
One of the reasons that people are pushing back on the idea of a rate increase next week is that this is still a supply shock. It's a supply shock on the tech side. It's a supply shock on the oil side. So the Fed really can't do much about it. If they raise interest rates, oil prices aren't going to come down.
Yeah, and you could also argue that even the hangover from tariffs, which still is in the pipeline, is also a supply shock. But that boils down to the family fight that they may have, namely, what does transitory mean? Should we think of the rise in oil prices we've seen in the last week as transitory, or should we think of that potentially could last longer? This is the incredibly complex discussion that they have, that the Fed now or the FOMC needs to come up with a conclusion. Well, how permanent do we think this shock to inflation is?
Now, obviously, things are changing with Kevin Warsh in charge now. But what about the old idea of the Fed should ratify where the market is?
Well, we don't know what the market really is thinking at the moment, other than, of course, that we have Fed Fund futures. But the problem is that it used to be the case with forward guidance that we would have some view on, well, is that close to what the Fed has been saying or not? But now the Fed didn't really provide much guidance. We still have the dot plot from the 18 members who did submit their dots. But we don't know if Kevin Warsh is going to support that idea of what the dot plot is saying, or if he is going to say, well, we got to increase credibility for the Fed right away and therefore come with a rate hike sooner than what the market currently is expecting.
I think about all the things that feed into this idea that the Fed needs to raise rate and why inflation remains sticky. And you've pointed out that the labor market is a big reason why as well. And the answer specifically lies in the unemployment rate, currently at 4.2%. Explain why.
Yeah, because the mirror image of the chart that you just had, Scarlett, showing that at the moment yields have been above 5 now for an extended period. We also have at the same time that the unemployment rate has been below the NAIRU, the natural rate of unemployment, which is what you see in this picture here. Specifically, the 57 months that you see to the right. Mm-hmm. This is the amount of months that we have been below the 4.5% number that the Fed normally, at least in the dot plot, thinks of as the equilibrium unemployment rate. That tells you we have a fairly tight labor market. And even going back to World War II, as you can see in the picture, we still have a very, very tight labor market for a very, very extended period. So that's another way of saying inflation has been above target since 2021. That's a very, very long time for the Federal Reserve to both have a very tight labor market and at the same time to have very, very high inflation.
Well, you've got people like Beth Hammack and Lori Logan using that as a reason to say we should increase rates, and they don't even have to focus on the oil price situation. Is that enough of an argument that we've missed the target for so long that obviously we're not tight enough?
Yeah, because that argument would say to maintain credibility as an inflation fighter, you need to show that we're fighting inflation when it's actually here, especially when it's here for such a long period. So this comes down to what we talked about earlier, namely, do we think that the shock is transitory from oil prices? If that's the case, maybe you could argue, well, inflation will likely then begin to come down. But if you think that we both have a very tight labor market and we have high inflation, and at the same time now we have a new shock also coming from oil prices pushing things higher, that of course is the argument for why they should be hiking next week.
I also can't neglect to mention tariffs because they reared their head again this week. President Trump's threat of imposing tariffs on Canada, on generic drug makers. How does the reimposition of these tariffs play into the inflation narrative?
Yeah, and this is very important because the Fed just had a survey where they asked businesses, have you implemented tariffs completely or do you still need to do more? And a significant amount of companies, they basically said, we still need to do more. So the fear is, of course, that it's not only new tariffs that have been announced here more recently, but it's also even in the pipeline of what was done last year. Companies are still adjusting and responding to the tariffs that have been implemented since April of last year. And that's, of course, the other factor that, as Mike was mentioning from the Fed minutes, comes out very clearly. It's not only about energy, it's also the lagged effect of tariffs. And then it is the Laura Logan argument together, of course, also with the several other members that talk about a hot economy, that generally speaking, when you have been deviating for targets so long, like Beth Hammock also said, that means that that's a third reason also for saying we should now begin to think about hiking rates.
And that's why increasingly people are saying perhaps the market is underpricing the odds of a rate hike next week. All right, Michael McKee, thank you so much. And of course, Torsten Slok of Apollo will be staying with us because still ahead, Gilts stalling near a 2-month high as the UK gets a new prime minister, a new chancellor of the exchequer as well. Our global return is next. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. Let's now step outside the U.S. for global return, because this week, Andy Burnham took over as the new Prime Minister of the UK. He spoke outside of 10 Downing Street about the challenges ahead.
I am acutely conscious that I am the 6th person in the last 10 years to walk up this street, the 7th Prime Minister since 2016. Making this a moment for reflection and new resolution. It requires my generation of politicians to raise our game and rise to the new challenge. Britain needs to show the world that we can regain our stability once again.
Burnham later told reporters that he would stick to fiscal rules, but also using any, quote, flexibility within them. UK government bonds dropped following those comments. Bloomberg's Georgia Hall joins us now live from London. So, first of all, let's just take a step back. What is the gilt market's overall take on not just Andy Burnham, but his new Chancellor of the Exchequer, John Healey?
It's certainly been a choppy week in the gilt market, and there's a lot to digest. John Healey came as somewhat as a surprise pick for Chancellor, and he's being viewed as somewhat of a safe pair of hands. He does have some former Treasury experience. He was the former Defense Secretary under Keir Starmer, and he has in the past pushed for more defense spending, so perhaps bond investors are looking to see how he plans to pay for that. But by and large, there's a lot of unknowns at the moment as to what his economic policies might be.
And Burnham said he would seek greater flexibility within the fiscal rules. How are people interpreting that?
Well, that was not interpreted so positively by the bond markets when he made those comments on Monday. And while globally yields have been quite high, UK bonds definitely reacted to those comments. Somewhat of a shadow overcast from 2022 when Liz Truss and her mini budget caused a lot of volatility within the UK bond markets, and so any sort of inclination as to meddling with fiscal rules, even though he didn't say that explicitly, he said he would look for flexibility within the fiscal rules, was taken as a sign, not necessarily such a positive sign by the gilt market.
And you point out that we've seen a bigger move in gilts than we have in sterling. Why do you think the gilt market is more sensitive?
A lot of that is to do with Liz Truss. From my conversations with investors, there's just this overhang, and a lot of people discuss how the UK acts like an emerging market in terms of its gilt market, just because it is so volatile, whereas sterling has a few other things that are simmering under the surface. There's also the Bank of England meeting next week, which could play into what sterling might do, but by and large it's sort of fizzled in the background okay, and it's puzzled a lot of investors, but it seems to be that bonds just are more volatile and more sensitive to any headlines that are coming out of number 10 Downing Street.
All right, Georgia Hall, thank you so much for joining us from our London bureau. I'm here still with Torsten Slok, Chief Economist over at Apollo. And Torsten, when you look at what's happening in the UK and indeed in Europe, long yields are definitely high. What's the connection between what you see in the US, the UK, and Europe?
Well, there are many of the same forces at play. Obviously, oil prices are going up. That creates problems for the Bank of England. That creates problems for the Fed. And by the way, also creates problems for the ECB. But one very important difference is that the US has an AI boom. We unfortunately don't have an AI boom in the UK. So therefore, growth and the growth prospects continue to unfortunately not be as great in the UK relative to what we have in the US. So that gives it quite a divergence in terms of the room to maneuver for the Bank of England relative to the US. For the US, it's more obvious that, well, if you have both strong growth and high inflation, you should be moving. But here you have a situation where you have high inflation and unfortunately not particularly strong growth. So one very important aspect that differs across the Atlantic Ocean here is the difference in the growth prospects. But the fiscal situation is also quite similar in the sense that, yes, Burnham and the government talks about Leahy also, of course, fiscal discipline. There were some comments about this earlier this week that maybe raised a little few questions. But broadly speaking, the fiscal situation is not great. The UK also needs to spend a lot of defense, just like other European countries. And the US also has a fiscal situation that is also putting upward pressure on rates. So the short answer is there are some factors, namely growth in the US, that's putting upward pressure on rates. But that's very unique to the US. But in the UK and in England, we have the same things that are driving things higher.
All right, Torsten, we're going to keep you here because coming up is our credit roundtable. We're going to speak with Colleen Cunniffe of Vanguard. She's the global head of credit research, and Lotfi Karoui. He is a multi-asset credit strategist over at Pimco. Ahead of that, we're going to check in and get a read on private credit from Blackstone. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for a moment of interest. Blackstone unveiling new funds to bring private markets to Main Street investors. The funds were launched just a day ahead of earnings this morning. Blackstone President and COO John Gray spoke with us about private credit earlier.
Redemption requests have come down pretty materially. So I would say this will take a bit of time to work through. Ultimately, as we deliver for customers, as they recognize that all the sort of town criers of doom in private credit overstated things, that yes, returns come down a bit as a result of a normalization of defaults and base rates coming down, but that this is a product that will continue to deliver.
Bloomberg reporter Loukia Gyftopoulou has been covering this story, and she joins us now. So, Loukia, he mentioned redemptions, and I bring this up because of the private credit funds. We've been tracking the redemption requests across the industry. What does that look like for Blackstone, especially as it launches new products?
I think it's something that they should be taking under consideration. I mean, it's been happening in the industry for a while. The products with Vanguard that they just launched do have like a big sleeve of liquidity because they have the index funds and so on, but it would be misguided not to think about the wider context of what's happening elsewhere in the industry.
Yeah, really well said. But when it comes to redemption requests, since they are opening up their world to investors, individual investors who may not be as comfortable as institutional investors with keeping their money locked up, what are they saying about what redemption limits look like?
So I don't think they're saying much about it. I think one of the funds has a 3% redemption limit. The other one has a 10% redemption limit. And they just stress the education and how clients will have to be educated. But as we saw with private credit, clients were ultimately educated in real time. So I think it remains to be seen when these funds scale up, what happens.
I like the way you put that. They're educated in real time. Loukia, thank you so much. Loukia Gyftopoulou is our Bloomberg News reporter here. Torsten Slok, chief economist over at Apollo, is still with us. Of course, Apollo, one of the big alt asset investment firms out there. Talk to us about how you see private credit interacting with the economy right now, because it's been a source of stress for a corner of the credit market, but it hasn't necessarily spilled over into the broader economy.
And that has a lot to do with where the problems have been in private credit, and it had really mainly been in software. Software makes up about 25% of direct lending, and software went through very big, significant problems. Number one, there was AI disruption risks, and number two, software companies happen to have very, very high leverage and very low coverage ratios. That means that software companies do not have great ability to do well in an environment where interest rates are higher for longer. And given that we keep on talking about interest rates are going to stay higher for longer because inflation is higher for longer, we have shock from the Middle East, we still have upward pressure on inflation, that means that in the private credit world, those businesses that are in the areas that have a lot of leverage and have little ability to pay that high level of debt, they are going to continue to struggle. And that's where really most of the problems in private credit have been located.
And of course, we look ahead to what's coming up next week. Blackstone just reported earnings, Alphabet just reported earnings, but the rest of the hyperscalers report next week. As an economist, as someone who looks at private credit as well, how are you going to be looking at those results?
Well, going into next week, as we just talked about, first of all, there's a Bank of England meeting. We also have an FOMC meeting next Wednesday. We also have hyperscaler earnings. 3 hyperscalers will report on July 29 and July 30. And now we also have the risk of escalating conflict in the Middle East.
Yep.
I mean, we're setting ourselves up for a fairly significant risk of an increase in vol. We're beginning to see some of those moves today. But the risk, of course, is that if there is a change in the narrative in any of these stories, in particular the story around the Middle East, especially also the story around the Fed, if the Fed does hike, and in particular also the story around the AI spending and the hyperscalers, that could potentially make next week quite volatile. And that's the risk, of course, when we look ahead.
But those who are positive on the U.S. economy will look at it and say, but there's so many things that are going right in this economy. The economy is holding up very well. The AI boom, for instance, shows that the economy is doing well. Even if there's all this talk about rising interest rates, things are holding off pretty well here.
And that's the paradox in some sense, that we really have a very good economic outlook. If I type ECFCGO on my Bloomberg screen and look at consensus expectations, they are really, really strong for GDP, for consumer spending, for CapEx spending. And even with that backdrop, we still have sector problems in software. We still have issues around what's the energy sector doing. And we now also have these issues around with the Google earnings yesterday, what's going on with data center spending, what's going on for the hyperscalers. So it's not the fundamentals for the economy. They're really doing really great. It's more whether the narrative that has driven things forward is going to continue.
Torsten, really appreciate your staying with us for the whole half hour. Torsten Slok, chief economist over at Apollo. Up next, the auction block. We're going to tell you about everything that's happening this week and our credit roundtable on Real Yield next. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. And for the second week in a row, banks led U.S. investment-grade sales. But overall, it's been a somewhat slow week compared to the volume that we've seen this year. Only U.S. Bancorp crossed the $2 billion mark. TD Bank, State Street, and Truist crossed the $1 billion mark each. And rounding out the top 5 was Netflix, with $1 billion in debt sold. It was actually the first bond auction for Netflix in 2 years, slowing sales growth, fueling some scrutiny over the company's future. This offering failed to match the demand seen in Netflix's 2024 debut, with sales orders worth about 3.6 times the amount on offer. You compare that to the previous deal, which drew 10 times Netflix's offer. And in sovereign wealth, Kuwait raised $6 billion from a 3-part dollar bond sale on Wednesday. That's a fairly resilient showing despite daily missile and drone attacks from Iran. Kuwait and U.S. bases in it have been targeted by the Iranian military for more than any other country. Investor orders for the bond sale reached $14.8 billion. Kuwaiti spreads have been among the lowest in emerging markets, thanks in large part to its oil wealth. Now, the other big story in markets this week, investors scrutinizing the massive amount of AI spending. Some people call it CapEx season rather than earnings season. Kay Her with JP Morgan Asset Management spoke about that on Bloomberg Surveillance.
You've had, $800 billion worth of CapEx expectations, $1 trillion worth of CapEx expectations. That's being funded in the equity markets, in the debt markets. It's being funded everywhere. I think the issue in the bond market is it gets to be indigestion. But on a market value basis, I think we're looking at 3% of the high yield market is now CapEx, this hyperscaler AI, and it's a little over 4% in the investment grade. So in the broad scheme of the markets, I think quite manageable.
Let's dig into all of those themes with our credit roundtable. Colleen Cunniffe is co-head of global taxable credit research at Vanguard, and Lotfi Karoui is multi-asset credit strategist at Pimco. Lotfi, let me start with you because Kay mentioned indigestion. There's very much an overhang of tech debt that needs to be digested by the market. And people have been saying that these bonds need to find their levels. Are we there yet, or has the steady pace of issuance extended that adjustment process?
Yeah, look, I think there's definitely some commonality between credit markets and equity markets in terms of the questions that we're trying to answer. But obviously, the tension between the magnitude of the CapEx and then monetization is a key question to both markets. But I think part of the reason why you now have that commonality is because this CapEx cycle is debt funded. And so every time you get the kind of revisions that we've seen in the CapEx numbers, there is almost like a one-on-one mapping between that and the future pipeline of issuance. And so I think the additional challenge for credit investors is to really try to find a little bit of a landing zone, not just for CapEx, but also for future pipeline. Concentration is an issue. Supply this year has been very concentrated, actually, within non-financials. If you look at the stock of bonds, or if you take the investment grade index as a barometer, we've been there before. I think, if you go back to 15, 14, the market was actually more concentrated than it is today. But certainly, if you look at the flow, which is what's coming through the primary market, that has exhibited significant concentration.
Colleen, let me put that question to you. What are you seeing?
Yeah, I mean, I can concur with what Lotfi shared. I think one of the key issues is not so much the absolute exposure in the markets at this point, but the concentration in the new issue flow. That said, this is one of the most important thematic stories of sort of my investment career. So I think what we're trying to do is figure out what the best spots are for us to deploy in this story, because there's going to be winners and losers. It's not a trade that we can sit out, but we're doing a lot of really hard work trying to figure out where we feel the most comfortable getting exposure in this new issue regime.
Right. You look at hyperscaler bonds, they're now among the worst performers in every market they were issued. Almost 80% of the sector's bonds sold since early 2025, Lotfi, are currently indicated at a wider spread versus the first trading day. Google's Century bond is now below 90% of face value when you look at the price. Is this kind of underperformance prompting active investors to underweight this sector? I mean, are they steering away from it?
I think it creates opportunities, for sure. I think it does bring pockets of excess carry into the market. By the way, that's true not just on the index side, but also if you look at some of the off-index bonds. So on the private side, it does bring opportunities. But I agree that eventually, the key question that we need to address is the predictability of the pipeline. Once you get to a place where the pipeline becomes a bit more predictable, I think you'll probably see early signs of stabilization in the spreads.
But it doesn't seem like we're there yet, Colleen. And if hyperscalers need to issue more debt, they're also doing so outside of the U.S. dollar market, which is already the world's biggest, to other geographies. And those other geographies can't necessarily absorb the supply. Is the absorption issue an even bigger challenge in smaller markets like the UK, Switzerland, or Japan?
Yes, it could be, but I think what issuers are doing at this point is looking for the best execution in the best market. So if they're confronting lower absorption in smaller markets, there are other markets, big liquid markets, that they can continue to pivot to, and we've seen that, right, as we've seen debt in the U.S. come across high yield, structured products, and NIG. So I think we'll continue to see issuers trying to maximize that opportunity set.
Do you think insurance companies have hit their concentration limits on the sector, Lotfi?
Well, no one really knows, but I always try to look at the history of the last 10, 15 years. If you go back to 15, 16, at the time, as you may remember, we had a boom in M&A, and a lot of those jumbo M&A deals were actually funded with debt. The share of the top 10 issuers in the IG market was actually higher than it is today. And so my guess is that we're not there yet. We're not at a point where concentration is becoming a problem. But people are definitely thinking about it. And, what matters is not spot, but the forward for the next 6 to 9 months. But we've been there before.
How do you hedge against this underperformance, Colleen? What's the best way to do that? Is it just to go to other sectors? Is it through products like credit default swaps, something else?
I think, from a credit analyst perspective, I think it's diversification, and you alluded to it. It's in two ways. One is, looking for opportunities in broader sectors that are not so concentrated in this theme. And number two, within this theme, is looking for the opportunities where we feel really comfortable, whether it's with the structure, the terms, the collateral, et cetera, to make sure we're investing in those deals, rather than taking a broad exposure to the AI theme.
And of course, when it comes to AI, we've only gotten SpaceX so far. There's also Anthropic, and we know that the bankers there are meeting with investors before an expected listing in the fall. Are we going to see Anthropic follow the SpaceX playbook? A massive IPO followed very quickly, Lotfi, by a massive debt raise.
I don't have an answer to that question, but the playbook of the last 6 months suggests that might be a possibility, that eventually an IPO might be followed by debt raise, but I don't have a clear answer to that. Yeah.
I mean, hypothetically, how much would an Anthropic have to pay up to access the market, given the underperformance of SpaceX secondaries?
That will depend on the timing, and it will depend on their ratings. But I think you could certainly draw a lot of lessons from the price action of the last 2 to 3 months.
Let's talk about data centers. Colleen, what's your current view of data center funding? There's a lot more questions being asked now than just a few months ago.
Yeah, and we're doing the work to try to figure out where the best opportunities are. One of the benefits that we have, having active research, active fixed income research, and not only that, but a breadth of teams to work with, is that we can step up and look at the relative value across these markets where issuers are bringing data center deals. So we don't just have to look, is it cheap to the issuer, but how does it look across the structured products versus investment grade? And so the key questions that we're trying to answer there is who's owning the residual risk? What does that residual risk look like? And making sure that the opportunities we select account for that risk.
Lotfi, what about you?
Look, this is one of the best environments for active management that I have seen in my entire career, just to be clear. And so I would very much concur with what Colleen said, which is doing the credit work, looking at the structures, making sure you have a certain level of downside protection for bondholders is key, but certainly not all deals are created equal. And again, I'll go back to what I said earlier, which is this is bringing a lot of pockets of excess carry into the market, and eventually will lead to more dispersion, and hence more, a greater sort of opportunity set for alpha generation at the single name level.
I also want to get in here one last question about M&A, because we had the news that the Paramount Skydance Warner Brothers deal is not necessarily going to go through. It's been put on pause for 2 weeks because the federal judge says it violates antitrust law. People make money trading on these kinds of situations, Lotfi. How do you position for this? What do you think potentially could happen here?
Well, I don't have a view on this particular deal, but I would say that if you go back to December at the start of the year, I think expectations were very high that you would see finally a pickup in the M&A cycle, and that a big chunk of those transactions would actually be funded in debt markets. In the end, here we are 7 months later. The biggest story has been the AI CapEx cycle. It's completely overshadowed M&A supply, but under the surface, it's actually happening. The share of M&A supply has increased, and I think on a forward basis, it would also continue to increase. But these are sort of, event risk type of situations, and they bring more dispersion. Again, this sort of strengthens the case for credit selection and doing the work. But when you look at the index, the IG index has been oscillating around, 70 to 75 basis points. But underneath the surface, I think there's a lot going on at the single name level, and that's where your alpha edge comes from.
Colleen, do you see anything in M&A that you can exploit on the credit side?
Well, I think on, for instance, the high yield side, M&A has been a little bit more present in the market for the first half of the year. I don't think the team expects that for the second half of the year. I think I'd concur with what Lotfi said. Like, that's part of the power of selection and credit research, is really trying to do the deep credit work and find the opportunities, whether they're coming from a situation of restructuring or coming from, big synergies in the future. Those are the kinds of things we're going to be looking at.
All right, Colleen, thank you so much for joining us. Colleen Cunniffe at Vanguard and Lotfi Karoui at Pimco. Really appreciate it. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcast. It's available on the terminal and wherever you get your podcasts. Now, still ahead on Real Yield, the NFL is following the footsteps of other sports franchises and tapping the private debt market. This is Bloomberg Real Yield. The National Football League selling more than $600 million in U.S. high-grade private bonds, tapping a market that's become a go-to source of funding for major sports franchises. Emily Graffeo joins us now. So this $600 million sale is through multiple transactions. Break it down for us.
Okay, so this is not the first time the NFL has come to the private placement market, but our reporting shows that they came a little bit later in June, $338 million. This is debt that's sold directly to institutional investors. Bank of America arranged the transaction. They're a placement agent. And then they came a little bit later in the summer, we think about early July, and they were looking to raise at least $300 million. So all in, over $600 million in private placement bonds for the NFL.
Why raise money through this private placement market rather than public debt markets?
So they've historically liked the private placement market. One benefit is that you don't have to register with the SEC like you would have to in a public securities offering. So they like the confidentiality, I'm assuming here. You can also get some flexibility with different tranches, and the timing is a little bit more flexible than if you were going to do a big public bond deal. But all told, our understanding is that they're one of the largest borrowers in terms of issuance in the private placement market. When they come, it's not like they're coming every month, but when they come, they're doing these fairly large sizes of transactions.
They make a splash.
They make a splash.
All right, well, it is the NFL after all. Thank you so much, Emily Graffeo. It's time now for our Muni moment. Palm Beach County commissioners rejecting a proposal to build a digital infrastructure hub to house AI data centers and warehouses, voting in line with opposition from local residents. Bloomberg's Erin Hudson joins us now with more. So why is this particular vote significant? Isn't this just one local zoning dispute?
Yeah, so this vote has been widely watched, and it's kind of taken on symbolic nature. It's sort of representing the challenge of the AI era. And a little more detail about the proposal. This project, if it had been built, would have been among one of the largest data centers operating in the U.S., and it would have generated millions of property tax revenue for the county. And the county staff recommended approving it with conditions. So the fact that the commissioners, the county, rejected the proposal in a state like Florida that has really gone out of its way, in a county like Palm Beach that has been trying to attract technology investment, it really does send a message and speaks to the power that local authorities have on determining whether or not these facilities go forward.
And the interesting thing to all of this is that opposition to data centers has become bipartisan in Florida. Why is that?
Yeah, so this is one of those issues that the blurring of the political lines is occurring. And in Florida, part of it is that for Republicans, it's about protecting the taxpayer, costs, local control. For Democrats, it's about environmental concerns, transparency, and it lands lawmakers in alignment in one of those rare scenarios. And we are actually seeing that across the country as well. Both blue states and red states are sort of dealing with these issues in similar ways and approaching it and talking about it the same way. So it's just speaking again to how the tides are sort of shifting on data center development.
Yeah, very much feels like then Palm Beach is not an outlier if you're seeing instances of this crop across the country. Erin, thank you so much for bringing us this story. Erin Hudson with our Muni moment. Now, still ahead on Bloomberg Real Yield, the Fed decides next week, and of course, we'll give you a preview of what Mike McKee is looking for from Kevin Warsh's second news conference. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time for my final thought. Traders are boosting rate hike bets ahead of the FOMC meeting less than 1 week away. Our Michael McKee joins us now again with more. And the idea that the odds are now up to like 38%, 39%, we're not at 50-50, but it's a tremendous move from just a few days ago.
And if we don't get a rate increase next week, the feeling is that we'll get one by September. And that's part of the dynamic in trying to figure this out. If you are going to subscribe to the idea that the Fed needs to raise interest rates, when do you do it? Because we had that sort of weak CPI report. Does that push it off to September, or does the idea that we're not sure how long this war stuff is going to keep pushing up oil prices push it off? But then you get to September, you could do it then. After that, it's October 28th, which is 4 days ahead of the midterms. They're not going to want to get involved in that. So it may be July or September, or you can wait till December, and that is too long. I think, for what the market is expecting.
Yeah, the political calendar is not very forgiving here. So it really, July would be the most, would be the timeline that would give you the most distance, right? I mean, even if you push it to September, that's going to invite commentary.
Well, and you're also going to run up against the end of the fiscal year for the United States. And if you're raising interest rates, you're raising the cost of financing the government. And we're going to have a lot of the bills they passed yesterday, the National Defense Authorization Act and the budget outline, a lot more treasuries are going to come to market, and they're going to come to market at a higher price. And that's definitely not going to make the president happy. So the sooner Kevin Warsh rips off that Band-Aid, maybe the better for him.
Absolutely. All right. So there's also tariffs to consider and oil prices, the resurgence of oil prices, which has been remarkable because we came down from the highs we saw when the president announced he would plan to, put a ceasefire in place. That has now all gone away. We've gone right back to almost the cycle highs.
Yeah, and that's going to have both an economic and a political consequence. Patrick DeHaan, the economist at GasBuddy, says we could go as high as $4.40 a gallon based on where oil prices have gone today. If that's the case, certainly people cut back. We've seen this on what they're buying in other categories of retail sales. Total amount they're spending is about the same, but they can't buy other things, so that's not good for other companies. And the economy may slow down a little bit. It may not bring down oil prices to raise interest rates, though, so it isn't clear exactly how this all plays out.
Is there any data that we need to watch for before the FOMC next Tuesday and Wednesday? There's PCE on the calendar, but it comes afterwards,
It comes afterwards, ironically, or unfortunately, because that would give the Fed a much clearer view of what their target is, because they target the PCE. It's expected to also show what the CPI and PPI showed, a little step back, but that's because gas prices fell.
Right.
Gas prices are back up
Different
again.
picture now.
And we're going to get more tariffs. I don't know what you buy. Well, you buy hockey sticks from Canada. So
yes, so I'm directly affected by these potential
by the tariffs. Yes.
Yes, I was thinking that when that came out because they highlighted hockey equipment as something that would be tariffed. So definitely top of mind here. So Mike, as you look ahead, just compare what we're seeing in the U.S. with what's happening overseas, because the ECB has left the door open to a rate hike in September. The BOE meets as well pretty soon. So this is all kind of converging.
Everybody's got the same problem with energy price inflation. They have different economies, but the headline that came out after Christine Lagarde's news conference today was that members of the Governing Council told our reporters that they're ready to raise rates in September. So they've pushed that to September and then told people they're going to do it. That's the forward guidance that Kevin Warsh doesn't want to do. Bank of England has a very weak economy, and at the same time, it has an inflation problem. So do they raise rates or do they put that off? They've got a tougher dilemma. In the U.S., raising rates 25 basis points isn't going to make a big difference to the economy. It will to the government, and it will toward the companies that are borrowing for AI spending, but it would send a message to the markets that they're in the right direction.
All right, Michael McKee, our Bloomberg International Economics and Policy Correspondent. I'm looking at the 30-year yield right now. It did hit 5.19%, the highest since 2007. Earlier this morning, it has since eased a little bit, but currently at 5.17%, staying elevated and holding above that 5% level. This is Bloomberg.